Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, in today's video, I am going to share my views on investing in small cap space and the theme that I am most bullish on for 2023. As the year 2022 comes to a close, it's a time to reflect and to prepare for whatever 2023 has in store. 2022 was a challenging year with Russia-Ukraine war, supply chain disruptions, inflationary pressure, tech meltdown, slowdown in the global economies, and lockdowns in China. And the rough ride is not over yet. A lot of these challenges continue in the current year. And while deglobalization is the flavor of current times, there is not enough of decoupling. I'm not predicting a doom and gloom situation, but knowing the unknowability of how macro environment could behave amid multiple events of global significance, I wish to be prepared for the developments that could influence the small cap space. But here are some reflections first. This was a year of dichotomy if you compare Sensex returns to that of small caps. While the former recorded a flattish gain of 1%, the small cap index lost 9% during the year. For the record, in 2022, the BSE small cap index witnessed a gain of 63% versus just 24% gains in the Sensex. Since the COVID crash, the total gains in the small cap index stand at 207% versus 130% in the Sensex. So, will 2023 mirror 2022? Let us first check the general market sentiments. At present, Sensex or BSE 30 is just 4% shy of its lifetime high. It is trading at a PE of 24 times, a level saner than 36 times in 2021, but at a premium to its long-term median of 20.2 times and not too far from some of its previous peaks. Now here is a very simple, conservative or base case prediction for Sensex over the next 5 years. You see the Sensex earnings growth has been at a CAGR of 13% over last 2 decades. If I expect the earnings to grow at the same rate over next 5 years and use a median P multiple of 20.2 times, the Sensex could be close to 96,000. Let us assume 1 lakh for the sake of simplicity. Also, since I am more focused on small cap space as an analyst, so let us see what this could mean for small caps. Unlike Sensex or BSE 30, the PE ratio for small caps does not make sense. That's because over 4,000 stocks fall in this category, a lot of which are loss making, that any investor with basic knowledge of fundamentals will not touch with a 10-foot pole. In fact, the stocks that would clear basic parameters of strong balance sheet, minimum acceptable liquidity, and sound management, and minimal or zero pledging would be much less than 100, and that's a lot that you should be looking at. So, for the lack of a sensible PE number, let's use another metric, small cap to Sensex ratio. This ratio at present stands at 0.47 times. This compares to the previous peaks ranging from 0.54 to 0.76 in the last 2 decades, which means that there is still room for small caps to rise before investors turn fearful. Now, if I have to make a projection for small cap index, I use a median small cap to Sensex ratio and the base case projection for Sensex. Since the base case prediction for Sensex is 1 lakh in 5 years, the projection for small cap index comes at around 44,000. That's a CAGR of close to 9% from the current levels over the next 5 years in a base case scenario. So even a base case scenario suggests better returns than FD for keeping cash. As such, I believe it makes sense to not wait on the sidelines but invest in quality small caps that offer enough comfort on sustainable growth over next 5 years. Another thing, at current level of 0.47 times, the small cap to Sensex is at a premium to long-term median of 0.44 times. You would not find enough low-hanging fruits in the small cap space. If you're not diligent while picking stocks, your investment journey could be doomed. Now here are a few filters I would recommend you to ensure. First, positive cash flow from operations. If you're only looking at earnings growth, you could be a victim of accounting gimmicks where profits are only on paper. A huge gap between cash flow from operations and earnings is a red flag that needs deeper analysis. And companies where the two move in opposite direction need to be analyzed with even more diligence if at all they interest you. Second, debt to equity ratio less than 1. That's because we are interested in sustainable growth and not the growth that is disproportionately reliant on borrowed capital. While high debt companies or stocks can perform well now and then, they are quite fragile. For any ladder you climb, another event like COVID or downturn in the industry cycle could be the snake to bring you down. Third, median or average return on capital employed. That should ideally be 15% or more. This reflects some prudence on the behalf of management when it comes to capital allocation decisions. If the business fails to offer a decent return on the capital invested, chances of a good return on the amount invested in its stock are slim. Fourth, look for promoter pledging. The lesser, the better. If there is indeed any pledging, look for the trend, if it is increasing or decreasing over time. I would be highly cautious of the stocks where the pledging is above 15% and has been increasing, and even more cautious with the stocks where the pledging is high along with low promoter stake. These stocks could be the victim of bulk selling by entity to whom the shares are pledged in case of a sharp stock price correction leading to a vicious cycle. And while we are going with a base case projection that suggests upside in the long term, you should be mentally prepared for phases when the going will seem tough. It's unlikely to be a unidirectional journey. Coming to qualitative parameters, avoid managements with shady history or the ones that have treated minority shareholders unfairly in the past. As they say, a tiger doesn't change its stripes. Be careful with the companies that are changing names frequently, hoping to whitewash the past reputations and poor impressions that they have left on investors' psyche. Look for companies where there is comfort on growth aspect. It would help to focus on industries and themes that are witnessing tailwinds. And that brings me to my favorite theme for 2023, which is the capex theme and the infrastructure revival. In 2022, at 19% of the total expenses, the budgeted capex was at highest level in nearly 2 decades since 2004-2005. In the past, when capex got such boost, the Sensex nearly quadrupled. The factors that could fuel the capex cycle have never come along together as they are doing now. This revival is not just driven by better ability of banks to lend and cleaner balance sheet of the companies, but it is backed by the policies by the government too. In 2022, when capex cycle witnessed a pickup, the budgeted capex saw a boost by 35.4%. This was backed by government's announcement on the PLI schemes. I expect this focus on infra to continue at least until next elections. What is also empowering the trend is the shift of global supply chains away from China and a portion of outsourcing and investments coming into India. Lastly, it is not just the macro policy factor. In earnings calls of the companies over last few quarters, the management's ambitions with regards to investment in assets and expansion is quite palpable. Despite a challenging and inflation-ridden 2022, the managements have gone ahead with the ambitious capex plans ahead as they don't want to miss catering to the long-term demand cycle. This capex cycle is creating assets in turn that will create a new earnings cycle. So coming to the specific stocks that I believe deserve to be on your watch list that are riding this theme, the first is Supreme Industries. Supreme Industries is one of the largest plastic processors with a pan India presence and a business that spans four verticals that include plastic pipes, consumer products, packaging products, and industrial products such as material handling or LPG composite cylinders and so on. The business is a key beneficiary of Jal Jeevan Mission, infra spending, and the upcycle in the affordable housing. Supreme Industry has an asset base of 35 billion rupees and it is envisaging a capex of 7 billion, a 20% expansion on the current base in 2022-23. This capex will be entirely funded from internal accruals. The balance sheet is debt free and it enjoys a cash balance of 5 billion. The ROCE is 31 and even in the year of COVID, the lowest ROCE was 26%. The working capital cycle is tight at 22 days. The average dividend payout ratio has been 34% over 5 years. The stock is trading at a PE of 36 times that seems high on depressed earnings in the recent quarters amid inflationary pressures. The second is RailTel, a PSU. This small cap with a market cap of 40 billion rupees enjoys an order book worth rupees 45 billion, of which rupees 20 billion is in the railway sector, and the rest is in defense, coal, and smart city projects. Basically, the company has strong footholds in the sectors like railway, coal, defense that are the focus areas amid infra spending and are witnessing strong policy support. It is also supporting the new avenues like health and education, etc. As per the management, the data center business that could witness boom due to digitization drive is a huge opportunity area for the company. The management has guided for a 20% growth. The business has negligible debt with debt to equity at 0.2 times. The ROCE is at 20% in FY22 while EBITDA margin was at 29%. While the cash flow from operations is positive, do note that the business typically has high receivable days, which is not a good sign. The dividend payout in FY22 was 37%, and the stock is trading at a PE of 20 times. The third on the list is Apcotex Industries. It is a leading producer of synthetic rubber and of synthetic latex in India. Its products find applications in paper, carpet, construction, gloves, specialty chemicals, and tire cords industry. The company enjoys leading market shares in most of the end segments it caters to. It is the only producer of nitrile rubber and high styrene rubber in India. Besides completing debottlenecking projects in the last 2 years that enhance the capacities by 10 to 15%, the company has undertaken two major capex projects for medical and industrial gloves and nitrile latex capacity, which will be completed in FY23. This will be the largest capex in the company's history. The medical glove industry itself is projected to witness a double digit growth in the post pandemic era, and the synthetic latex is likely to substitute natural latex due to allergy issues in the later. This expansion will create the capacities in synthetic latex by 92%. The capex will be funded 50% from debt and rest from internal accruals. The revenue potential is estimated at 5 billion on full utilization. Even after these expansions, the company will have enough space to increase capacity by further 50% in future with less investment. Coming to the numbers, the net debt to equity stands at 0.3 times. ROCE or return on capital employed is 35%. Dividend payout stood at 26% in FY22. Cash flow from operations has been positive. The stock is trading at a PE of 20 times. I would recommend you to not consider these as recommendations, but companies that deserve to be on your watch list as the riders of the capex theme. In any case, whatever stock you pick, make sure you're not overpaying. Companies that are trading at a price earnings to growth or a PEG ratio of higher than 1, or the ones that are trading at a sharp premium to their peers in the same industry, or at a premium to their long term median PE multiples, while do not warrant an outright rejection, need to be approached with caution. You should have very strong conviction to justify the price that you're paying. So that's all for today's video. If you found it useful, please like, comment and share, and do subscribe to Equity Master channel for more such content. Thank you for watching. Goodbye, and I wish you all a very happy new year.